All right, so take a minute and let you guys read through this. This is just some disclosures that we have to make for you guys. So take a couple minutes and read through that for me. All right, we'll go ahead and move forward with that. All right, and with again, welcome to Financial Planning Basics. We got a lot of ground to cover here. Some of the topics we'll be touching on, just simple setting some goals that you can accomplish. We'll be discussing budgeting, as well as creating an emergency fund. Touch on insurance protection. Many instances, building a financial plan involves incorporating credit, so we will cover a little bit of using credit. I'll talk about some basic investment concepts, understanding how pre-tax and after-tax allocations along with tax-deferred growth can help you pursue your goals. Touch savings for college, planning for your retirement, and last, certainly not least, we will also look at the fundamentals of estate planning. So if we're going to touch on the setting of your goals, one of the steps in financial planning is you being able to accomplish the goals that you set. Setting goals, you're defining your dreams for the future. Some goals may be things you want to do in the not so distant future, such as pay off credit card debt or buy a new car. Other goals may be more distant. Do you want to buy or build a new home, start your own business, pay for college for your child or your grandchild, or would you like to retire early? Your goal is the foundation of your financial plan because you need to know what you want to accomplish before you begin saving or investing. Once you've identified and prioritized your financial goals, you can develop a clear-cut savings or investment strategy that can help you turn your dreams into reality. Your goals as concrete as possible will help you focus on what's really important. A goal that's well-defined will be easier to visualize and easier to stick with. To set clear-cut goals, you can use what's called the SMART technique. SMART is an acronym that stands for specific, measurable, attainable, relevant, and timely. Specific is one that's clearly defined and described in detail precisely what do you want to accomplish. For example, I want to save for my child's education is not a specific goal, but I want to save for the cost of 4 years at homegrown university by the time my daughter turns 17 is clearly defined. Measurable, you should be able to track your progress and clearly know when you've reached it. For example, I want to retire early, not much of a measurable goal, but I want to retire by my 55th birthday is a goal that has a definite point and something that we can help you get to. Goal is a realistic and reachable goal. Goals be challenging, but you should have a fair chance of achieving them. I want to save $1 million in 5 years. Not so attainable for most people. Some people it is, but most people it is not. However, I want to save $1 million in 30 years as a very attainable goal. And then goal is one that makes sense to you and that reflects your specific needs and your values. Goals that are relevant are goals that you will be excited about because they will be important to you. For example, I saved $25,000 for a down payment so I can own my own home is an example of a goal that might be a relevant one. And then finally, you must be able to set a time frame or a deadline for reaching your goal. I want off my credit card debt by the end of next year is a goal that has a clear deadline. Right, prioritizing your goals is an essential first step towards putting a financial plan into action. The first thing any financial plan into action requires you to control your flow of money. That's part of what a budget is all about. Budget your income and expenses and helps you direct the flow in a way that you want it to go. Our budget first account for all of your income. This includes your paycheck plus any income that you might have from other sources, such as like rental income, governmental benefits, interest on money you have in the bank, or even investment income. From that, subtract your expenses, and expenses are really broken down into two categories here. We have the expenses are those you pretty much have to pay, such as or a mortgage payment, car payment, insurance, utilities, groceries, and basic clothing. Discretionary expenses are more optional items, such as eating out, entertainment, gifts, and vacations. It'd be a little difficult to handle all these expenses, especially discretionary one. You may want to keep track of them for a while, either with a pen or paper, or on a computer software program to help see what you're spending. And remember, not all your expenses occur on a weekly or monthly basis. Some are seasonal, like holiday gift expenses or home heating costs. Other occasional, like car repair or getting a cavity filled. It may take several years of tracking some expenses to get a good idea of what you spend on an average per month or year. Track your average expenses for a given period, a month or a year, from your income for the same period. If there is a positive number left over, it's what's called in the black or running a surplus. A surplus can be converted into savings or an investment for the future. But if it's a negative number, that's bad. That's what's considered the red, and you're running at a deficit. You're spending than you're making, and the only thing that's really going to change that equation is either increasing your income, so perhaps getting a second job, or decreasing your expense. And it's usually the discretionary expenses or the fun stuff that's the easiest to reduce, or do both. Look on the right side, you're running a surplus. One of the first things you want to do with the surplus is create an emergency fund. So, emergency fund. Emergency fund is that is readily available to meet unexpected expenses. Is really the foundation for any successful plan. Money to fall back on when an unexpected expense crops up. You may be forced to tap into savings that you've earmarked for retirement, college, or another savings goal. But if you have an emergency fund, it will be much easier to handle a job loss, temporary disability, or even that might prevent you from saving for the future, or even tempt you to pile up debt. How much you have in an emergency fund? Popular rule of thumb is that you should have an emergency fund equal to 3 to 6 months worth of your living expenses. But should you save 3 months, 4 months, 5 months, or 6 months worth of your expenses, the amount you should have depends on many factors. How stable is your income? Do you work in an industry where layoffs are common, or on a growing field? Do you have health and disability insurance? Do you have other assets that could tap in without penalty in an emergency? Where you emergency fund is also important. And a jar, or what I call a couch fund, is probably not the best idea. You'll want to keep your money in an account where it's readily available, but you'll also want to receive as high a return as possible. Rarely you write one check equal to 6 months or even 3 months worth of expenses, so you may only need part of the fund, something as liquid as a savings or checking account. The balance of the emergency fund can be held in something getting a better return, but you can still access it in a day or two. Another important part of the financial planning is identifying and managing the potential risk that can impact your finances. The value of insurance is that it is a cost-effective way to mitigate or share the frequently overwhelming costs of various risks. So we'll spend a couple moments looking through those types of risks. First, insurance. What used to be called health insurance has actually been replaced by health care plans. Most plans provide basic coverage for common medical expenses such as doctor visits, preventative care, diagnostic tests, hospital and extended care, emergency services, as well as prescription drugs. Auto insurance is another type of insurance, but it has two main components to it: liability insurance and insurance for property damage. Liability insurance provides compensation to people or persons who would be able to sue you for personal injuries, medical payments, loss of earnings, or damage to their property. Property damage insurance includes collision and comprehensive coverage, which compensates you for damage to your car caused by another auto or such things as fire, theft, and vandalism. Life insurance also is a defensive risk management. It it's the replacement of your income to your survivors in the event that you pass away. It can provide income tax-free death benefit, and it can be used to pay for funeral expenses and even medical expenses of the last illness that you had. For most, our most valuable asset is our home. So the most common type of homeowner's policy in use today covers a variety of risks that can cause damage to your home and personal property, medical payments for injuries to occupants and to persons injured by accident while in your home, and loss or theft of personal property. Life insurance is often your last line of defense against potential devastating claims for things over which you may have little or no control over. It's often called umbrella insurance because it carries over all other liability insurances and usually adds $1 million or more in extra coverage to your homeowners and automobile liability policies. Coverage is provided for you, your spouse, and any relatives living in your household and insured by your primary policies. Disability insurance, and disability insurance would take or would a check in the event that you become disabled and give you disability income. And it can bring independence, maintain your lifestyle, give you time to recover, provide a chance to retain for another job if necessary, and as well as conserve your assets and savings for you and your family. Long-term insurance is the last one. And what that is it's a private insurance that pays benefit if you need extended care, such as nursing home care. Other types of insurance, long-term care insurance, protects you against a specific financial risk. In case, the chance that the need for long-term care will wipe out your life savings. Establish an emergency fund, and you've insured yourself against certain risks to your financial security. And to meet your normal expenses, you've planned a budget, but sometimes you need more funds than what your budget may cover for that moment, and that's where credit comes in. A caution here, don't rely on credit to cover your normal living expenses. If you could be headed down a dark path that may lead to financial disaster. If you're using credit to pay for normal living expenses, it should be because it's convenient to do so, not because you don't have those expenses planned for in your budget. So what is credit? Well, Merriam-Webster's dictionary defines credit as the provision of money, goods, or services with the expectation of future payment. When it comes to financing big-ticket items such as college education, a home, or even a car, most of us will need some sort of loan. And there are many times, like shopping for Christmas or going on vacation, when it's just more convenient to use credit, of course in the form of a credit card, to make purchases. Some creditors decide to grant credit. It depends on how well you meet their 3 C's. Know if you have the capacity to repay the credit they grant you. They'll want to know about your income and your expenses. Okay, once a creditor determines that you can repay a loan, the next question is, will you? This is a matter of your credit character. To measure this, they'll look at factors that measure your stability. How long you had the same job and lived in the same place. And if you've used credit before, they'll also want to look at your repayment track record. Do you pay on time? Particular loans of larger amounts, like a car loan or a home mortgage, a creditor might also want some collateral. Collateral is tangible property that secures the credit extended to buy it. If you default on repaying the loan, the creditor would be legally entitled to take possession of the property as a form of compensation. Credit your creditworthiness primarily by examining 3 documents. The credit application. You will fill out. A potential lender will ask for your personal information. It will also include your income and its sources, and may ask you about recurring expenses or other debts. Your credit report will be given the lender a wealth of information about your payment history. And finally, your credit score comes from a statistical formula that analyzes the information on your credit report, compares your profile to thousands of others, similar profiles, and produces a 3-digit number that predicts your level of future credit risk. The information gleaned from these 3 documents may not only determine whether you can get credit, but also what interest rate and other terms you are offered. When you're going to loan or use a credit card, you create a debt. Some debts may be small, a minor purchase on a credit card, and may be repaid quickly. Others are large, a home mortgage or a student loan that may take years to repay. How poorly you meet the repayment schedule for the debt will have an ongoing effect on your credit history and your credit score. Debt may be divided into two basic types. You have secured debt, and then you have unsecured debt. Eventually, you may have some of both. So what are they? Secured debt is debt backed by a lien or on collateral. This includes mortgages, home equity loans, car loans, or even a secured credit card. Unsecured debt does not place a lien on any real or personal property to secure it. Examples of unsecured debt are personal installment loans, student loans, and most credit card accounts. When you think of taking on debt, there are several important considerations. The first is the amount you borrow obviously will have a big impact on the size of your payment no matter what term. You have to repay it or the interest rate you're charged. You'll need to consider that within review of your budget. When looking at an installment loan, the term of the loan is the length of time you have to repay it. Generally, larger loans have longer terms. While longer terms help make your monthly payments smaller, remember that a longer term also generally results in a higher total interest payment over the life of the loan. Revolving accounts such as credit cards don't have a fixed term for repayment. Instead, a certain percentage of the current balance due is expected each month. The smaller that percentage is expected to be, the longer it can take to repay the entire balance. Now talked about using credit and the potential for accumulating debt, let's talk about investing and the potential for accumulating wealth. Associated investing with speculating or gambling, do you think of it as betting on the market or trying to time the market in order to make a quick profit? Or do you give it more as a long-term methodical saving effort to build for the future? Well, to each, investing involves taking a certain amount of risk, and it also involves the desire to multiply your money over time. Done properly, investing is carefully planned and prepared approach managing your money with the goal of accumulating the funds you need. Planning your investment strategy is about discipline and patience. When investing, there's a direct relationship between risk and return. It is in general, as the potential for return increases, so does the level of risk. Or stated another way, the less risk an investment has, the lower for the potential of return. Investment plan that's right for you depends largely upon your level of comfort with risk, what's known as your risk tolerance. You can completely avoid risk when it comes to investing, but it's possible to manage it. There are two key questions that you need to ask yourself to determine your risk. First, how comfortable are you personally with risk? This is a subjective measure, and it depends on many factors including your financial goals, your life stage, personality, and investment experience. Some investors are comfortable with a high degree of risk. Others can't tolerate very much at all, and a lot of people fall somewhere in between there. The second question is, how well is your investment plan set up to handle potential losses? The more resilient your overall plan is when faced with a potential loss, the more risk it might be able to take on. For example, time can be a powerful ally. The longer you're going to be invested, the more flexibility your investment plan might have to survive setbacks along the way. There are key terms you'll need to understand when planning for investments. These words are probably familiar, but they have very specific meanings when it comes to investing. We all want our money to grow. When it comes to investing, growth means that the investment has the potential to grow in value. If that happens, you might be able to sell it for more than what you originally paid for. Income comes from regular payments of money, interest on savings accounts, and it is income. So interest on CDs, interest paid by a bond, and dividends paid by a stock. See, the third potential objective of an investment is to protecting your principal. An investment that focuses on stability concentrates less on increasing the value of that investment and more on trying to ensure that it doesn't lose value. As much as I might like to, we can't have all three. The relationship between growth, income, and the stability of our investments. The more important one of these areas becomes, the more you may have to trade off in terms of the other two. The key is to tailor your investments according to what you want them to do for you and to balance stability, income, and growth so that maximizes your overall returns at a level of risk that you're comfortable with. To talk some specific investment vehicles, let's first mention some important tax considerations. You're going to allow you to cover some ongoing expenses with pre-tax dollars. Pre-tax dollars are funds that you are taking from your pay before certain taxes on your pay are calculated. For example, your federal income tax. Your taxes are then calculated on the remaining pay, and this creates a tax savings for you. For example, if you're in a flat 25% tax bracket and you're allowed to buy a $100 commuter pass with pre-tax dollars, the pass really only costs you about $75 in after-tax dollars, or what's considered take-home dollars. The result can be a lower out-of-pocket expense for you. Opportunities, if your employer offers them, where you might cover expenses with pre-tax dollars, may include paying for your health insurance, disability insurance, dental insurance, and vision insurance premiums. Your employer may also allow you to contribute pre-tax dollars to a flexible spending account or an FSA for medical expenses or dependent care expenses. With FSA, you can contribute pre-tax earnings to the plan and submit qualifying expenses to the plan for reimbursement. And as mentioned above in our example, your employer may allow you to pay certain qualified commuter or parking expenses with pre-tax dollars. You also offer a retirement plan like a 401k plan or a 403b plan or even a 457b plan. What these plans have in common is that they allow you to elect to contribute a percentage of your earnings on a pre-tax basis. Plans are intended to be used to save for retirement, and they offer advantages that go well beyond the fact that you get to fund them with pre-tax dollars, as we'll discuss later. Another consideration is that some specific investment vehicles allow for what's called tax-deferred growth. Whether you're investing pre-tax or after-tax dollars, tax-deferred growth basically means that you won't owe any taxes on the growth of the investment until you withdraw the funds from the account. In cases, qualified withdrawals from these investment vehicles may be tax-free. Some of investment vehicles that qualify for tax-deferred growth are 529 college savings plans and prepaid tuition plans. A 529 plan is funded with after-tax dollars. Your investment grows tax-deferred until you withdraw the funds. At that time, if funds are used for qualified educational expenses, the funds may actually be withdrawn for tax-free. Both traditional and Roth IRAs also allow tax-deferred growth. In the case of traditional IRAs, your contributions are made with after-tax dollars, but they may, if you qualify, be tax-deductible on your federal income tax return. This is important because tax-deductible contributions lower your taxable income for the year, saving you money. And the funds in the traditional IRA are sheltered from federal income tax until withdrawn. As for the Roth IRAs, if you qualify on the basis of your income and contribute to one, your contributions made with after-tax dollars and aren't tax-deductible. But the news is that if you meet certain conditions, your withdrawals from a Roth IRA, including any investment earnings, will be completely free from federal income tax. With investment vehicles mentioned, for example, the 401k plans, the IRAs, and the 529 plans, a 10% penalty tax applies if you take the distributions before a certain age or for a non-qualifying purpose. So tax deferral. Let's illustrate the value of that. Let's assume that you have $20,000 to invest. You put $1,000 into a taxable account that earns 6% per year, and you use the portion of these assets each year to pay taxes attributable to account's earnings. You put the other $10,000 into a tax-deferred account that also earns 6% per year. Assuming 28% tax rate applies, in 30 years your taxable account will be worth about $35,500. Same amount of time, your tax-deferred account will have almost $57,000. That's of over $21,000. Of course, funds in the tax-deferred account might be subject to federal income tax when withdrawn, but even if you took the entire amount in the tax-deferred account as a lump sum distribution after 30 years and paid tax on the full amount, you would still come out ahead of this example. At 28%, you'd end up with a little over $41,000. Again, a note of caution, depending on the specific tax-deferred vehicle, an additional 10% penalty could apply if you took the distributions before a certain age or for a non-qualified purpose. Additionally, the illustration assumes a fixed annual rate of return over the 30-year period. Of course, in real life, the return on a portfolio will vary over time according to the market conditions. This is particularly true for the long-term investments. Okay, we have some understanding of investing either pre-tax or after-tax dollars in vehicles. Let's look at a couple things you might be investing for. People, the two biggest life events they need to save for are college education for their children and funds for their own retirement. Let's spend a couple minutes talking about the savings for college. Perhaps your potential Harvard grad is still in diapers, but given the cost of college, you'd be smart to start a systematic college saving plan now. And one that's available for savings for college is a 529 plan. Because savings vehicle offers the advantage of tax-deferred growth, it should be the cornerstone of any college savings plan. So what is a 529 plan? A 529 plan is a savings vehicle that is governed by the federal government and offered by certain states. Anyone can open a 529 plan, and there are actually two types of 529 plans: college savings plans and prepaid tuition plans. Plan, which is the more popular type, is an individual investment account to which you contribute money. Your money is allocated to your choice of one of the plan's pre-established investment portfolios, such as generally range from conservative to aggressive in their amount of risk. Returns aren't guaranteed, but funds can be used at any accredited college. Almost every state offers a 529 college savings plan, and you can join any state's plan. The second type of 529 plan is a prepaid tuition plan. As its name suggests, when you join this type of plan, you actually prepay your child's college tuition at today's price. The use you make today is generally guaranteed to cover a certain percentage of college tuitions tomorrow. However, you are typically limited to your own state's prepaid tuition plan, and your child is limited to the colleges that participate in the plan. They're generally in-state public colleges. The benefit of a 529 plan is that your contributions grow tax-deferred and earnings are completely tax-free at the federal level when they are withdrawn to pay the beneficiary's qualified education expenses. Note, however, that withdrawals that aren't used for the qualified expenses are subject to federal income tax as well as the 10% penalty tax. Additionally, there are fees that could occur. The life event you need to save for is your own retirement. Even if you feel you're too far away from retirement to start thinking about it, it's important to start planning now. Many people assume they can hold off saving for retirement and make up the difference later, but this could be a very costly mistake. The further off your retirement is, the more time your investments have the potential to grow. Waiting too long can make it very difficult to catch up, and only a few years can make a big difference in how much you'll accumulate. First, invest $3,000 every year starting when you're 20 years old, and if you retire after age 65, you'll have accumulated almost $680,000, assuming a 6% annual growth rate and no tax. If you age 35 to start saving $3,000 annually, you'll accumulate only about $254,000. And if you wait till age 45 to start saving, you'll accumulate only $120,000 by the time you retire. Now, this does not mean that there's no hope if you're 50 years old and you haven't set aside anything for retirement yet. It makes it that much more important that you implement a plan today. Of course, this is only an illustration and used to make a point. Before getting for your retirement, you need to ask yourself three basic questions. What kind of retirement do I want to plan for? When do I want to retire? And how long will retirement last? Savor and close your eyes for a second and picture your own retirement. Whether you yourself on a golf course, a yacht, a hammock, or simply in a living room, Most of you probably imagine some degree of financial independence. To a large extent, maintaining financial independence in retirement depends upon the lifestyle that we want. About when you'd like to retire? It's important because the earlier you retire, the shorter the period of time you have to accumulate funds, and the longer the period of time those dollars will need to last. Although you can retire anytime, most people wait until they're eligible for Social Security retirement benefits. You can start receiving Social Security benefits until age 2, and the earliest you can receive full Social Security retirement benefits is between the ages of 65 and 67, depending on what year you were born. Also not eligible for Medicare health coverage until age 65, so if you want to retire before then, you'll have to pay for private health insurance. As we discussed, the earlier you retire, the longer the period of time your funds will need to last. But how long should you plan on your retirement lasting? Keep in mind that life expectancy has increased at a steady rate over the years and is expected to continue increasing. The point I make is that for many of us, it's not unreasonable to plan for retirement periods that last more than 25 years. One of the ways to accumulate funds for your retirement is to take advantage of a special tax advantage retirement savings vehicle. 401k plans can be very powerful savings tools because your contributions come out of your salary pre-tax, reducing your current taxable income, and also tax deferred until withdrawn. And 401k plans can include employer matching contributions, a form of free money if you would, which would make them your first choice in saving for retirement. You may also be able to make Roth contributions to your 401k plan. Since they're after-tax, not pre-tax, contributions 401k contributions don't provide you with any immediate tax savings, but they allow you to make withdrawals completely free from federal income taxes under certain circumstances. Traditional ways like 401ks feature the tax-deferred earnings growth, and you can lower your current taxable income if you qualify to make tax-deductible contributions. And like a 401k, funds in traditional IRAs aren't taxed until they're withdrawn. Roth IRAs, like Roth 401ks, don't permit tax-deductible contributions, but they allow you to make completely tax-free withdrawals under certain conditions. Since these bills are intended to help you save for retirement, a 10% additional penalty tax applies if you take withdrawal before reaching age 59 and a half, unless an exception applies. A complete financial plan should also involve estate planning. So let's briefly take a look at that. Here is the topics that we'll be reviewing. We'll get into, and I always struggle with this word, intestacy, and why you might want to avoid it. Next is the importance of wills and trusts. Then we'll finally discuss incapacity and what happens if that happens. So let's die leaving $50,000 in a savings account. Who does that money go to? Without instructions from you, the money would go where your state's intestacy laws direct to go. Intestacy laws vary from state to state, but here ye a typical pattern of distribution. 50% of your property goes to your spouse and 50% to your children. Remember, it may be different in your particular state. The biggest with intestacy is that your actual wishes are irrelevant. Without an estate plan, regardless of what your wishes are, your estate would be divided between your spouse and your children. There are many problems with allowing your property to pass by intestacy. Intestacy can be particularly problematic for unmarried couples, since intestacy laws generally will not include an unmarried partner in the distribution of property. There's a simple way to avoid this, though, and that's create a will. So what is a will? A will is probably the most vital piece of anyone's estate plan. A will document in which you direct how your property will be dispersed when you die. It allows you to name an executor who will carry out your wishes, which are stated in your will. And then your will let you name a guardian for your minor children. You use your will to accomplish other estate planning goals as well, such as tax planning. but to be your will must be in writing and signed by you. Your signature must also be witnessed. These requirements are important because if you aren't careful, your will may be invalid. So you see an estate planning attorney just to be on the safe side and avoid any of those do-it-yourself situations. Take a look at a little bit about incapacity and why you should plan for it. Incapacity describes a condition in which you are legally unable to make your own decisions. Think for a moment what might happen if, for example, you were to become the victim of an accident that puts you in a coma for several months. How does your doctor know what medical treatments you would want or not want if you can't speak for yourself? How would your personal business be transacted if no one is authorized to sign documents for you? What then is this? Someone has to go to court and get legal permission to do things for you, and that person who's called a guardian and is usually a close family member, such as a spouse or child, would have to court every time permission is needed. As you can imagine, this might get quite burdensome to the guardian. Further, without any prepared instructions from you, your guardian might make decisions that would be different from what you would have decided. Fortunately, these situations can be avoided with proper planning. Healthcare directives also allow you to leave instructions about the medical care you would want in conditions where such that you couldn't express your own wishes. And proper management tools ensure you can have your financial affairs taken care of for you in the event you become incapacitated. Once again, an estate planning attorney can set all of these things up for you. As you imagine, from what little we've touched on in this presentation, is quite a bit involved when it comes to even the most basic financial planning. It's in your best interest to ask questions and begin designing a comprehensive financial plan that's right for you. I want to thank you all for your time. You've been a wonderful audience, and I would welcome the opportunity to meet with individually with each of you to address any specific concerns or questions that you may have. Again, you can get a hold of me through email. My email is broberts, my first initial of my name and my last name, at wpcu.coop, and my phone line is 937-431-2354. You can always feel free to give me a call and leave me a voicemail or an answer. I'll be happy to take care of it. If you guys need anything else, reach out to me, but you guys have been a great audience. Thank you and have a great day.